The tax revenue crisis is a situation where the federal government does not collect enough taxes to cover its spending and debt obligations. This can lead to a debt ceiling disaster, which is when the government reaches its legal limit on borrowing and risks defaulting on its payments. The tax revenue crisis has several causes and effects. One cause is the coronavirus pandemic, which reduced economic activity and tax collections in 2020. State tax revenues fell by 6.4% on average from March to August 2020 compared to the same period in 2019. Another cause is the tax cuts enacted by Republicans in 2017, which lowered the corporate tax rate and other taxes for high-income individuals and businesses. These tax cuts reduced federal revenues by about $200 billion per year. The effects of the tax revenue crisis are severe for the federal budget and spending. The government has to borrow more money to finance its programs and services, such as health care, education, defense, and Social Security. This increases the national debt, which reached $31 trillion in 2020. The debt-to-GDP ratio, which measures how much the government owes relative to the size of the economy, also rose to 97% in 2020, the highest level since World War II. High debt levels can reduce economic growth, increase interest rates, and limit the government's ability to respond to future crises. The tax revenue crisis also creates a risk of a debt ceiling disaster. The debt ceiling is a legal limit on how much the government can borrow to pay its bills. Congress has to raise the debt ceiling periodically to avoid defaulting on its obligations, such as interest payments, salaries, benefits, and contracts. However, raising the debt ceiling has become a political issue, with some lawmakers demanding spending cuts or other conditions in exchange for their support. If Congress fails to raise the debt ceiling in time, the government could run out of money and default on its payments. This could trigger a financial crisis, a recession, and a loss of confidence in the US dollar. Therefore, the tax revenue crisis is a serious problem that could lead to a debt ceiling disaster if not addressed soon. The government needs to find ways to increase its revenues and reduce its spending and debt levels. Some possible solutions include reforming the tax system to make it more fair and efficient, closing tax loopholes and evasion, stimulating economic growth and recovery, and prioritizing essential spending over wasteful or unnecessary programs. Hitting the debt ceiling means that the U.S. government can no longer borrow money to pay its bills, which include interest on its debt, Social Security benefits, Medicare reimbursements, military salaries, tax refunds, and many other obligations. If Congress fails to raise or suspend the debt ceiling before the Treasury Department runs out of cash, the government will have to choose between two bad options: either stop paying some of its bills or default on some of its debt. Both options would have devastating consequences for the U.S. economy and the global financial system. According to the Council on Foreign Relations, a default on U.S. debt could trigger a financial crisis that would cause interest rates to spike, stock prices to plummet, credit markets to freeze, and economic activity to contract sharply. A default could also damage the U.S. dollar's status as the world's reserve currency and undermine the credibility of U.S. Treasury securities as a safe haven for investors. Even if the government avoids a default by prioritizing debt payments over other obligations, it would still face severe disruptions and hardships. According to Bankrate, millions of Americans could see delays or reductions in their Social Security checks, Medicare reimbursements, tax refunds, veterans benefits, and other government services. The government could also be forced to furlough workers, cut spending on essential programs, and postpone payments to contractors and vendors. These actions would reduce consumer spending, business confidence, and economic growth. The consequences of hitting the debt ceiling are not hypothetical. In 2011, when Congress came close to a default, the stock market lost hundreds of billions of dollars in value, consumer confidence plunged, and economic growth slowed. The credit rating agency Standard & Poor's downgraded the U.S. sovereign rating for the first time in history, citing political gridlock and fiscal uncertainty. In 2013, when Congress again flirted with a default, the government shut down for 16 days, costing the economy an estimated $24 billion and 120,000 jobs. The debt ceiling is a self-imposed limit that does not affect the amount of money the government owes or spends. It only creates unnecessary risks and costs for the U.S. economy and its citizens. Many experts have called for abolishing or reforming the debt ceiling to avoid future crises and protect the U.S. creditworthiness and reputation.